Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings everyone, Jake Bernstein, a raspy voice Jake Bernstein, in allergy season here in California. It is May 8th, and we're going to talk today about seasonals and cycles, and the day is Thursday. So I'm showing here a chart of the Dow Jones 1920 to 2025. We're certainly talking here about a great deal of history. It is a composite chart. In other words, I've taken every year of the Dow Jones and I've made the low of the year 0, the high of the year 100, to give us what's called a normalized chart. It shows the pure DNA of the market without any one particular year having an effect. So it shows what the market would usually do without any influences from exterior factors such as earnings and so forth. And what we can see is a series of arrows up and arrows down in most cases. You will see nothing but arrows up. Meaning what? These particular weeks with arrows up show high probability moves to the upside, and if there were any red arrows here, they would show moves to the downside. The numbers inside the box show the percentage of time up or down by week. I realize this is a long-term chart, and the world today is dominated by short-term and day traders who have no interest in this information. However, if you know the markets as I do, since I've been trading for over 50 years, you will know that the big money is made in the big move. So if we go to this level right over here, April, 3 months in a row, 3 weeks in a row, up arrows showing a seasonal cyclical tendency to the upside. The first week of May, then the first 2 weeks of July, then this whole series of arrows up toward the end of the year. These are the kinds of moves that have high probability. They're not perfect, but they do show tendencies to the upside, or in other words, cyclical behavior, which we know to be a fact. So when I talk about cycles, I don't talk about cycle theory. I don't talk about the Elliott wave theory or Fibonacci. I talk about a fact. Seasonality is a fact. Seasonality is a cycle that occurs year after year after year. The good news, the probability is very high. The bad news, it's not perfect. But then again, in the world of investing, in the world of cycles, nothing is perfect. So beginning from this base, we want to examine what tends to happen in the month of May, what tends to happen in the month of June. And as you can see, June is basically unpredictable in terms of its underlying seasonality. It's a 50-50 proposition. In May, it was the first week that's to the upside. In April, it's the first 3 weeks, which I talked about before. But you'll notice that this did not really happen this year. Why? Because as I said, cycles and seasonals are not perfect, and we need to take the combination, setup, trigger, and follow through in order to make sense out of this and in order to make money out of this. Interestingly enough, and juxtaposition and ironically, for many centuries, scientists and budding scientists have attempted to bring clarity into life by using methodology, mathematics, and logic. Ironically, once we got there in the form of artificial intelligence, it has brought less clarity and more vagueness, less transparency. So now we have a situation where that thing, science, artificial intelligence, which was designed to give us massive growth, cures for diseases, cures for problems, is actually creating less clarity through deep fakes, and we question our very existence and our very future based on whether AI will take over and run things in its own fashion. It's a very strange juxtaposition. So what do we need to do? We need to deal with clarity. Numbers bring clarity if they're used in the right way, and that's what this is all about. We're using seasonality to generate numbers that give us the edge and take back the advantage that has been held closely and within politicians for many years. It's interesting that politicians, especially in the United States, can amass such a large amount of money through their inside information and inside knowledge, in most cases completely legally, while the average individual is left out of the picture. Here in the United States, we point to the dictators and oligarchs throughout the world, but in fact, it's really no different here when a politician can have the advantage over an individual investor using inside information, in many cases legally, to gain the advantage financially. We have our other tools. We have seasonals, we have cycles, and we need to use these seasonal cycles to our advantage in order to get back the edge that we lose through inside information by politicians. So that's my political statement now, my little political philosophy. But let's take a look at reality. The month of May, after the first week, is basically unpredictable historically. The month of June is completely unpredictable historically, meaning what? It could go either way. We need to be able to take tools such as this one and ferret out the patterns and see if they have any value in investing. And then, once we've established our methodology, we will use this to our advantage to take back what we lose in the way of inside information and opportunity by others. So, how are we going to do this? We're going to do this by using a process which I've spoken of many times before, and that process is setup, trigger, and follow through. You're probably getting tired of listening to it, but the fact of the matter is, sometimes making money, sometimes getting the advantage is boring, unexciting, rote, and easily done by a computer. So to review the chart, we know that prices in the Dow tend to be low toward the beginning of the year and higher toward the end of the year. We know that we can zero in on specific levels and specific times, for example, the first 2 weeks of July. But in the scheme of things, in my trading model, this tendency is a setup. It's a pattern. We are surrounded by patterns, whether those patterns be cycles, which are provable beyond a doubt, statistically and mathematically, or things like the Elliott wave, which is also a pattern, but difficult, if not impossible, to demonstrate the efficacy of mathematically and scientifically. So we need to be able to ferret out fact from fiction, which is becoming even more difficult every day, even with the advent of AI. Because now with AI, we don't know what's fiction and we don't know what's fact. So we're looking here at a chart that shows facts, but within the scheme of things, setup, trigger, and follow through. This is a setup. Excuse me. In order to use this setup, we need a trigger and we need to dig deeper into the methodology. Let's do that. I'm going to go here and I'm going to click inside the box to give me a more specific representation of what has happened in May over the last 105 years in the Dow Jones. And here's the daily chart. So let me bring the chart down a little bit on the screen. One moment, please. And here we go. Today is the 8th. Right over here, this is where we are. It says that basically today has been a 50-50 day. In fact, there's been only one day of the entire month, the 29th of May, that has been predictable to 63% of the time. Otherwise, it's a sideways proposition. What does that mean? Number one, it means that if you're a short-term trader, there's opportunity for you here to use this pattern back and forth, trading technical indicators such as moving average channel, divergence, stochastics, and so forth. There's no set particular trend in terms of the quote-unquote market DNA, as I like to call it. What else does it mean? It means that we can abandon seasonality in terms of repetition at this time of the year for the market as a whole. However, that does not mean that there are individual cases that do show very high probability. Let me show you what I mean. So remember, when we trade, it's a market of stocks, not a stock market. Think about that. The advantage is to be gained by specific attention to individual stocks. Excuse me. So let's do this. Let's go back to our seasonal charts. In fact, let's do something even better than that. And I want you to appreciate something. Appreciate the fact that we're covering here over 1 century of prices. The fact that most traders are willing to look only at 5 years of prices indicates they're myopic in their view. They don't have enough history. The more history you have, the better things are in terms of probabilities. So we may remove some situations that are not consistent, even though they looked good for the last 5 or 10 years. What we want is those trades that have been consistent and those investments that have been consistent using this pattern, using this approach. So I'm going to go back to the top of the screen. And remember, none of this is rehearsed. I have no prepared script. I'm strictly ad-libbing, as you can probably tell, but I want to show you my process because remember, not only do you need structure, but you need process. How do you apply all this? I'm going to go here to search for seasonal trades in stocks, like so. US stock trades. And what I have here on the left is a list of the 500 S&P stocks and 100 NASDAQ stocks. And I'm going to ask a question. So I'm going to pick a name that I know, Adobe, like so. You've probably seen this process before because it's one of my favorites. And not only does it contain the best setups, but it also gives you a very good perspective on what a stock has done over time. And if you believe, as I do, that the future is basically the same as the past in terms of tendencies, then you will find this to be a great service and value. Remember, nothing here is 100%. This is strictly a tendency, and we get to decide by ferreting out information from history which tendencies we want to use. So I'm going to ask a question. For the month of May, historically, in Adobe, have there been any stocks that have had a tendency to make a particular move 80% of the time? Very simple question. I can add further to this and say, I'm only looking for short-term opportunities that have been repetitive. So I'm saying, have there been any predictable up or down moves in the stock of Adobe during the month of May? Very simple question. And fortunately, through massive computer power, we can answer that question like so. And the computer says, no, there's been nothing here of that ilk. That's fine. I'm going to return to my search and ask a further question. Maybe my expectations were too high. Maybe there hasn't been anything at 80%. So let's try 70%. We're doing an iterative search here. Furthermore, let me add, this is a case in which we can use AI to go through trillions of calculations to find what we want. And it can do it very quickly. So let's ask for 75%. Because I'm willing to be right 75% of the time if my profit in sum total is larger than my loss. So let's go to the search. And computer says I'm barking up the wrong tree. No problem. And by the way, this is called research. Remember what Einstein said, and believe me, I'm no Einstein. Einstein said, research is what I'm doing when I don't know what I'm doing. So let's give it a little more time. Maybe we're being too demanding. And ask the question, is there anything here in terms of time I'm going to remove the restriction of time and let the computer search 75% month of May. Let's see what we get. Exciting, isn't it? Nothing. Well, we've learned something very important. We've learned that Adobe is not a seasonal stock. It does not have seasonal tendencies. So let's do this. And again, totally unrehearsed. Let's go to Abbott Labs, certainly a stock that has been around for a long time. And if there's going to be a tendency, we can find it. If you remember, in the old days of trading, by which I mean the 1960s and 50s and 70s, this process I'm going through right now was called data mining. It was given a negative connotation. People were told, if you search the data, sooner or later you will find what you want. That's right. We will find what we want. We'll find what we're looking for. We're looking for that needle in a haystack that has had a tendency to repeat, which is statistically reliable. The more data you have, especially looking over 100 years, you know that what you get will be valid statistically. So let's do the search. 75%, Abbott Labs, month of May. Here we go. Well, interestingly enough, the computer gave us what we were looking for. And it says, buying Abbott Labs, end of day, May the 9th, with an exit July the 31st, has been right 78% of the time for many years. And what do I mean by right? I mean profitable. But in order to get to that, you need to risk a 12% stop against you, close only. So let's look at the history. And by the way, remember this. Very few traders, very few cyclical researchers have the ability to analyze this amount of data so quickly, and therefore need to rely on very questionable statistics when they risk their money on a trade or an investment. So let's take a look. Here's the history. And this is the year-by-year history going back 42 years, which is a very respectable amount of time considering most traders won't even go back 5 years. Why won't they do that? Because they don't want to know the ugly truth. But here is the truth right here. Everything we need to know. The tendency, the losing years, the winning years, the cumulative performance, and so forth. So what do? We can save this information if we like it. So we go back to the top of the screen, and you can see everything about it. The stock, the entry, the exit, the stop loss, close only, everything we need to know. Very impressive. So let's go back here. You will notice that these are all variations on the theme, the same idea. Buying Abbott Labs on these various dates, or waiting until this one over here for a shorter term trade. But you'll notice the statistics are very important as well. The profit to loss ratio, the average profit in points, the average profit in percent, the average loss, the maximum number of consecutive wins, all very important for the trader. Let's return to the search. I'm going to scroll through my list and pick another one, just at random. Let me get rid of this. And let's keep the same search criteria. And let's scroll down the list, and there are literally hundreds of stocks here. So the choice is yours. Let's do this. Let's do Berkshire Hathaway, given the fact that they had their annual meeting this year, just a few days ago, and given the fact that Warren Buffett will be stepping down. So we're searching Berkshire Hathaway for the month of May using the same statistics. Here we go. A moment of great suspense. And here we've got quite a few trades. But you'll notice a problem. The problem is this. In order to achieve this kind of performance, we need to risk a 100% stop, which means no stop. I'm not happy with that, so I'm going to go back, and with the power of the computer, I'm going to rerun this, and I'm going to put a limit on it and say I am not willing to risk more than 5%. Stop. So I go like so. And by the way, I'm not giving you a demo of some software. I'm showing you that there is seasonal tendency in all markets, especially in the major averages, but we can ferret down and go to specifics in terms of days in trade, length, stop loss, and so forth. So I'm going to go to the stop and say, I like these trades in Berkshire Hathaway, but I don't want to risk more than 5% of my investment. So we'll do a search with that limitation. Computer says, you're not willing to risk enough. And remember, folks, there's a very specific relationship between risk and reward. Sometimes you need to risk more in order to make less, but to have good high probability of success. So I'm going to increase the stop like so, and I'm going to go to 10% and see what we have there. Here we go. And by the way, all of these trades are optionable. Here we go. Still. So what is the computer telling me? I'm gaining valuable information here. That information is this. In order to make money on Berkshire Hathaway in May with 75% odds, I need to be willing to risk more. So let's just step into the deep rabbit hole here and say, I'm willing to risk 25%, which I'm never willing to risk, but you can mitigate that risk with an option. So let's go to the search. And computer says, yes, there is one trade in Berkshire, May 25th through December the 11th, with 76% odds. And let's look at the record. I always like to look at the record to see, is it volatile? Is it trending higher most of the time? Does it have big corrections? Here we go. And here it is, looking at 29 years of history. And the performance right over here. So as you can see, it was a little spotty back here in the 2010s, but it's been very consistent since then, showing profits almost every year for the last 8 or 9 years. So this is a trade I'm interested in, and I can save it and do further analysis on it. But remember, this is step number 1. This is only the setup, waiting for a trigger. We can alleviate the 75% odds and increase our odds of success by using a timing trigger, which basically says, when we get to this date, right over here, the entry date, on May 25th, is the trend of the underlying market in Berkshire Hathaway up or down? If it's up, we take the trade because it is consistent with what the market normally does at this time of the year. However, if it is trending lower at this time, because this is a long position, unless our timing indicator says the trend is up, which makes us be consistent with the trend, with the seasonal pattern, then we take the trade and apply the statistics, the stop loss, and so forth. Let's do this. Let's do one more before I totally run out of voice. I did want to make some important points, and I think I've made most of them. Setup, trigger, follow through. Let's go back. Let's return to the search. Let's go to our list and look for a stock that everybody and their brother knows. So let's go to a stock like Nike. So let's go there. One moment, please. Here we go. And here's Nike. Let's ask basically the same question. I'm willing to risk 25%. In fact, let's make it a little bit less, because 25% is not a realistic number for me. It's way too much risk. So let's go back to the box and go back to our 10% risk and see what we get. And remember, this may be a boring process, but it does work And it is most important of all, it is absolutely, totally, statistically based on fact, not fiction, not earnings, not interpretation, not analysis, but fact. Here we go. Nothing. So remember what I said before. It's a process. Let's do this. Let's decrease our expectation. Are you happy with 70% probability? Some will be, some won't be. And again, you can mitigate that risk with an option. In this case, a call option. What do we have? There we go. The computer has put the best trade in terms of statistical probability at the top of the list. May 26th through August 18th. Oh, wait a minute, it's still Berkshire. I'm the victim of my own software. Just one moment, please. Let's return to the search. And let's get rid of Berkshire. Like so. And keep Nike. Here we go. And let's repeat the search. One moment, please. And here we go. Let's repeat the search. Yes, we go. Here's the trade. May 20th through July 25th. And remember, these days, a trade of that duration would be considered a long-term trade. Very few people are interested in trades that last that long because they want to take the quick money, grab it, and run to the next opportunity, which I am not so sure is the best idea, especially since the big money is made in the big move. So let's look at the history. There it is. Nearly 40 years of history. Very impressive. Let's look at the cumulative performance. And I like this even more. Why do I say that? Because we've had 2 consecutive losing years. You will observe from the history, there's never been a case of 3 consecutive losses. Therefore, this trade is especially attractive. But remember what I said. It needs a timing trigger. And that timing trigger is your choice. If it is proven to be reliable in terms of identifying the trend. So to be clear, what we're looking at here in Nike stock on the specific entry date. Let's go back to the top. Just one moment, please. Here we go. The specific entry date, May 20th, end of day. If on that date, our trend indicator is reading up, because this is a long trade, then the trade is triggered, and we go to step 3, which is stop loss, follow through, etc. Let's go back to the chart and do one more thing that you might find interesting. Let's go back here 1 step. One moment, please. And again, apologies for the lack of voice. Here we go. And we're going to look at the seasonal chart for Nike. Here we go. And this is a vast amount of information. Much more information than most traders have or ever will have. So here we go. The yellow highlighted part indicates the period of time for which the computer has chosen to show us the trade. So this is the trade we're looking at right over here. And you can see that historically, after a small correction down, it tends to move higher again and show stellar performance on the upside from the last week of October until the last week of November. And this is an area we'll be focusing on in the future, and I'll make note of that so I don't forget to do it. So what have we done today before my voice runs out? We looked at the seasonal composite chart for what happens at this time of the year, and we saw that in May and June has been basically unpredictable in terms of the Dow, but not necessarily unpredictable in terms of individual stocks. I showed you setup, trigger, and follow through. I discussed it. The trigger is up to you. I have my favorites. The setup is clear and easy to find. And remember, you can do this on any valid, effective, functional, seasonal trading software. I'm not the only game in town, and I'm not trying to sell you anything except an idea. The idea is, again, setup, trigger, follow through. No matter what anyone tells you, it's all in the numbers. If the numbers are not there to support their opinion, then you're dealing with opinions. Opinions are not facts. Show me the money is the most important thing. So before I run out of voice entirely, I want to reiterate the fact that you need to deal with facts. If you're dealing with a strategy or a cycle that is an opinion as opposed to a fact, you're dealing with something that's elusive and not scientific. In these days of fake this and fake that, we want to make sure that we're dealing with facts as opposed to fiction, with facts as opposed to opinions, and that's how we do it. There are many other ways in which to do it, but this is my seasonal way, and I hope you've enjoyed the seasonal cycles. And we'll be back next time with more clarity and much more voice. Thank you for your patience.